What's up, people? I'm here with Vicky, Cardinal Financial.
Yep.
She came to visit us at one of the properties that we're building here in Bergenfield. So what's up, Vic? What's going on?
Man, I'm like hearing you. You're busy. You're on the phone. We're checking out your flip. It's exciting stuff. You know, given where we are with the market today, such a market shift.
It's wild.
It's wild. It's so wild. I was telling you earlier, I'm going through the process myself. I'm not a first-time home buyer, but I'm using a low down payment option to purchase this property, a multifamily, and I'm just having a tough time making those numbers work.
It's tough because obviously your qualifications, and you know you're the one that runs these numbers.
Yep.
Your qualifications are not this. Your payment is not the same on 500 with a 4% interest rate versus a 7% interest rate. So what you need to do is you need to, instead of buying a house for 500, you need to find a house for like 400, 425.
Right.
So what needs to happen is the sellers need to come down a little bit
On
so
the
that
purchase price.
on the sale price, in order for a payment to be affordable.
Right, absolutely.
Because you can't have a high sale price and have a high interest rate, because it just doesn't work.
Right.
So, but there's a program out there that you're offering that's kind of cool with the buying down the points. Can you tell me a little bit about that?
So you're hearing all this buzz on social media, like 2-to-1 buy down, 2-to-1 buy down.
Yeah, what is that stuff?
What is that stuff?
Yeah, what is that stuff?
Right. And do I even qualify? So it's not a grant, right? It's 2-to-1 buy down.
So explain it to me in
layman's terms, right?
That's easy for a regular homeowner to understand. So go ahead.
Exactly. So what it is, it works if you're purchasing a house, you know.
And my rate is, say, 7%.
Your rate is a 7%. So you say, okay, I want to do the 2-to-1 buy down. So year one, your rate is going to be 5%. Year two.
So how do I go from a 7% to a 5%?
You're buying down that rate. So it's in form of credit.
Okay,
seller's credit, builder's credit, developer's credit.
Got it. So if the house is worth, if the mortgage amount is, say, $600,000, how much does it cost me to get from a 7 to a 5?
Good. We need to do the calculations on that.
But just give me like a rough estimate.
So every point is 1% of the loan amount.
So on a, say, $600,000 mortgage, so it'll be, say, $12,000 for my rate to be from a 7 to a 5. Just a rough estimate?
Yeah, pretty much rough estimate. Yeah.
So people, if your rate is, say, 7%, what Vicky is talking about, and the program that she's talking about, is that if you buy 2 points, you could go from a 7 to a 5, and that makes your mortgage affordable.
But here's the one thing, right? So the buyer's not paying for this. The whole idea is that you're getting it in form of seller's credit.
Okay, so I got it. I got the credit. So let me explain that to you guys. So if the rate, so if I'm giving somebody, say, $12,000 for them to buy those rates, instead of me pricing the house at, say, 600, I would price it at 612, give them back $12,000 in order for the rate to go from a 7 to a 5.
Right.
And then that makes the rate, the payment a little more affordable.
Much lower for year one and year two.
For year one and year two. So we're hoping that the markets, that the rates come back down, and then they can refinance in, say, 2 or 3 years.
Right. Well,
is that correct?
We're all hoping that the rates can come down.
What about if they don't come back down?
So you have to be comfortable with paying that monthly mortgage payment. And I think this is where a lot of first-time home buyers are struggling. Although they may qualify for a $500,000 purchase, does it make sense to pay close to $4,000 in your monthly mortgage payment? You have to come to terms with that. Listen, I'm going through the process myself. Does the property make sense? Do my monthly mortgage payments make sense? Does the rent roll make sense, right? So these are all the things that I think as a home buyer, right? Me being a loan officer, but also a buyer in this market, numbers are much harder to make sense today than it was, let's say, 3 months ago, or let's say last year. But here's the one thing I will say, this is, again, coming from experience. We're in a less competitive market. Much less competitive.
There's not that much demand for the houses.
Not that much demand. So more negotiation for home buyers. Most likely to get my seller's concession accepted. I can negotiate a bit of the terms. And see if I can bring that purchase price down. So although it is a great opportunity to home buyers to like get offers accepted, it's a lot harder for people to be comfortable with that monthly mortgage payment. And I think that's where creativity then has to kick in.
Yeah, so I like the program, all right, Vic. I really
Yeah.
like the program, but one of the things that I want the clients to understand is, just be careful, because if the rates continue to go
Yes.
up in 2 years,
Yes.
it could be dangerous. Because say your mortgage payments are $4,000 down. Let's just use it as an example,
Yes.
right? With the taxes and with the insurance. If the rates continue to go up, say in 2 years, then your payments could be $5,000 or $5,500. So that's a little scary
That is very
sometimes
scary.
for a lot of buyers, because they're betting that the rates are going to come back down or that the rates are not going to go back up. So
That's right.
I think that we as a developer, as a seller, and you as a loan officer should disclose that to the client, and also put it on paper and say, hey, if in 2 years the rates go up and it resets, your payment can jump from a $4,000 to $5,000 to $6,000. We don't know
Right,
where that
right.
is, and if you can't afford it,
Shouldn't
then
do it.
you're gonna go into foreclosure,
Absolutely.
or you have to sell the
Absolutely.
house,
Absolutely.
maybe at a loss, and that's a little dangerous for a lot of buyers, because I experienced a lot of that crazy stuff in 2008. And you always want to be sensitive towards all of that stuff and foreclosures, because a lot of people
Yeah.
can get themselves
Right.
in trouble.
Yeah. And listen, I think this is where loan officers come in, right? We're no longer in that market crisis where banks was just the wild, wild west.
Correct.
We're lending like crazy, right? You do have to qualify based on your debt to income ratio. Your documents, your income, assets, W-2s, it's all verified. So it is a lot harder for people to obtain a loan, but you're absolutely right. At the end of the day, you have to look at the monthly mortgage payment and say, am I comfortable paying that every single month? Or am I leaving myself cash poor? If you're leaving yourself cash
dangerous.
poor, it's not a good idea to purchase a house.
So the important part for the consumers and the borrowers, find a reputable loan officer that's just not going to try to sell you a loan and say, I got you approved, and not explain to you all the details on these sophisticated loans, because these loans are sophisticated, right?
Yeah.
It's not like a 30-year fixed or a 20-year fixed or whatever, just not a fixed product. It's a sophisticated product. So as a loan officer, you want somebody that's reputable, that's going to sit down with you and your family and explain to you everything detail by detail, because you don't want something bad to happen to the borrower in 2 or 3 years. But we're hoping that the markets, they come down with the rates a little bit, because I think they overshot. I think when you look at the chart, Vic, they usually raise the rates like this, right?
So gradual.
Right.
Gradual.
And then they kind of went
exponential.
they went like this, and this is like the highest rate increase in like history. They've never done this before, and a lot of economists are saying, hey, I think they went overboard with the rates and they need to bring them down a little bit.
Yeah, I mean, that's what we're all
Is that what they're
hoping for.
saying?
That's what we're all hoping for, but we're not market predictors.
Right.
We can only use history, we can only use statistics, and what we're seeing as far as the Feds, right? Fed's announcement of raising the interest rates. And then we can say, okay, make educated decisions based off that, but we don't have that crystal ball that says, rates are going to drop within 6 months or 12 months. I wish we did.
Right.
But,
and then, what you're saying is absolutely right. And then the other point that I want to bring up is, I know that you're looking to buy a house, and I know you're going to be doing some renovations on your house.
Yes.
So what are you experiencing? What are your fears? And what are your concerns? Because I know that you have the solution to everybody's problems, but what are you experiencing?
Own problems.
Yeah, what are you experiencing? So we're going to find out what's going on with Vicky and what's going on with her real estate situation.
Yes. Maybe, you can give me insight on
I'll give you some
what are the
advice.
possibilities. So I am looking for a 2-family, and I'm looking to finance it with a low down payment option. And I'm looking in areas where the taxes are relatively low and price points are within the $500,000, right? So I did get in one property offer accepted, and with a concession, a seller's concession, was just fine.
That's good.
I didn't think, that would go through, but it did, with the $12,000 seller's concession. So calculating closing costs, cash to close, down payment, drove, I think, close to 30,000. Then in order for the property rent rolls to make sense and at least be making a profit, I'd have to renovate the basement, which would cost me an additional $30,000, right? To get
outside of the closing?
Outside of the closing, right. So then the question to a home buyer like myself is, if I have to come up with $30,000 for my cash to close, which would include my down payment and my closing costs, how am I then financing an additional $30,000 to pay a contractor and do the
Well,
basic?
you've worked with the 203K loans where they give you the money to do the renovations,
Yeah.
but $30,000 is not that much money, so you're gonna have to be creative.
Super.
Maybe with the seller and say, hey, is there any way you could increase the price and do the work for me if he's a contractor, or can you increase the price and give me a credit or something along those lines because
Yeah.
I need to do the basement in order for it to be affordable.
Yeah.
One of the things that I like that Vicky is doing is that she's buying a 2-family house, and I love 2-family houses.
They're called the house hacking.
Yeah, because it's smart, because even for myself, I'm always nervous when I see a house where your mortgage payments are like $5,000, $6,000, $7,000 a month. I'm like, I like to eat pizza. I want to go have a couple of beers on Fridays with the guys.
Right, exactly.
So I don't want to be in a situation where my mortgage is so high, like you said, it was house poor.
Cash poor.
Cash poor.
Yeah.
So I don't want to be in a situation where my mortgage or your mortgage is $6,000 or $7,000, and all your money goes towards your mortgage.
Right.
So I like the 2-family house, and I like that you're renting out a portion of the house so that you can offset your mortgage payment. And then the $500,000 is not a bad price point.
Not
it's
at all.
a really good price.
It's a really
point.
good price
You have
for
parking?
multifamily.
You have parking?
No.
No parking.
No parking.
No.
No.
Don't
You need
move
the
to Jersey
parking.
City. You have to move.
So I'll ask you
someplace.
this, Dom, as a builder, as a developer in the northern New Jersey area where people love to live, and where we are now, Bergenfields, beautiful, gorgeous suburban, great schools, close to the city,
Everything,
right? Everything, right? So you get that picket fence living, right? How are you trying to be more conscious of your end buyer, right? When you put this house on the market now, knowing that the rates are going to be high, knowing that the monthly mortgage payments will be high. What's been your strategy shift since we've seen this?
That's a really good question. That's a really good question, right? So I see people that drop $30,000, $40,000 on kitchens. I see people that are dropping, $10,000 on one bathroom. So my goal is to build a house, an affordable house, where I give you the box, right? Basic electric, the electrical, the plumbing, the new appliances, new kitchens, basic bathrooms. But I don't really get fancy with like the moldings and the floorings and stuff like that.
That would drive the cost.
Right, because when you look, instead of you spending $250,000 on renovations, you'll spend $350,000, $400,000, right? So that only adds cost to the price of the house. So I try to build a basic house, and the customer, as he lives in the house and as years go by and his financial or her financial situation gets better, they can do a fancy bathroom. They can change the floors. They can change it. And you could do it over a long period of time.
Right. So the builder strategy, and not every builder, but for the most part, has shifted to, let's keep the cost of build
Let's give
down.
them a brand new house.
Let's give them a brand new house, but we're not going high end on the appliances, on everything. That makes a lot of sense.
Yeah, because
you keep your costs down and your profit margins still make sense. And,
and it's good for everybody, because if I build too fancy of a house or too big of a house,
price will be too high.
Then it's going to be too high, and then
the
customer can't get into the house. So we're trying to be that middle where we say, hey, we'll give you a brand new house. We'll give you that brand new basement that you want, but let's not get too fancy on the flooring. Let's do a $2 a square on the flooring, because you can go crazy and buy $4 a square, $5 a square, right? So we want to give you the product that you need and the services that you need and everything that you need, but we also want to bring in the cost. We want to keep the cost as low as possible. And you're young, I'm not going to say her age, but she's young. So she's going to be in the house for 5, 10, 15 years, and then she could always add anything fancy to it as her financial or the client's financial situation gets better.
Right, yeah.
Do you like that?
I like that. And usually what I heard from stats is the average homeowner stays with their property for 5 years before they sell it. So, even better.
Well, no, not really. Are
you hearing the opposite?
No, because if you buy the right house in the right neighborhood, you could be in there forever, and you don't have to sell the house. You could
Millennials
rent
like myself don't stay in places.
Well, if don't sell it, just rent it out, and then
do
it
a
pays
cash
for
out
itself.
refinance.
It pays for itself.
Yeah, it pays for itself.
Yeah. So when you finish with the house, maybe you refinance it with Vicky.
Yeah.
Take out a little bit of money, rent it out, let it pay for itself, and 30 years from now, 30 years from now, you don't have a mortgage. And the house doesn't have the house is worth a lot of money.
And you've got so much equity.
Right.
So I'm going to ask you something else. So we talked a lot about like first-time home buyers programs like the 2-to-1 buy down and seller's credit and getting creative, and so many other programs like I'm hearing on social media, the Bank of America, 0 down payment, 0 points. And these programs exist, right? But let's say for someone that's watching, like the first-time investor, that they're so motivated by all these social media videos, these flippers, these investors, so much money to make in real estate, and they're asking themselves, well, how do I get in? Is it the right time to be a first-time investor?
I think you have to, and that's a really good question. We all have issues. I have a couple of, I think Vicky asked me how many deals I do a year, and I did 7 to 10 deals a year. And then say 2 of them, 3 of them didn't work out the way I projected, but thank God that I have the other ones that did, that overshadow the ones that didn't. But if you only have one deal or one deal and it falls apart, you're in trouble. So you have to be careful. I wouldn't put all my money into one basket. I would do partnerships. So if you're going to buy a house, I always suggest maybe buy it with your brother or your sister.
You're saying buying it and financing it as an investor with hard money, or you're saying buying it as a
homeowner?
As a homeowner, okay.
Right. So if you're going to buy it, say a 2-family house, maybe buy it with a brother or your sister or a family member where you guys are buying it together.
That's
where
actually
one person.
A great suggestion, given today's current market and the interest rates and increased mortgage payments, is go in with a family member.
Yeah, and you don't have to worry about them paying the rent or not paying the rent, because they're paying half the mortgage, and they're not going to want to mess up their credit and their down payment and their equity. So everybody's like together, the family stays together. And you also want it to be cheaper than your current rent. So if your rent is, say, $2,500 a month, you should get into a mortgage that is going to be, say, $2,000 each.
Yeah.
So you save $500 a month.
You do.
Something along those lines. But I wouldn't overshoot and buy an expensive house or overpay for a house.
I wouldn't either.
Just be careful.
I would be wary. I said I would never say never, but I would be wary to get into a single family home given the current interest
Correct.
rate today.
And a lot of unless you're financially stable and you're making
the mortgage payment needs to make sense.
Right.
It needs to make sense. So I'm going to shift a little bit. We talked about a lot of first-time home buyers. I recently started to work with a lot of first-time investors, which is why I asked, but they're looking to purchase Airbnb and finance Airbnb properties, right? And I'm working with a lot of newbies that are so new to it. Some already, I know you have a lot to comment, some already have a home, their primary home, and then they ask me, well, how do I finance an Airbnb property? There's several ways to do it, right?
Yeah.
But one of the ways, I actually finance mine as a secondary home.
You have one in Orlando.
I do. Last year. Now it's a lot harder to use that vacation secondary home loan to do Airbnb. They're getting a lot stricter on that. But the other option is the DSCR loans, the no income verification loans. You can finance it. Rates are going to be higher, like in the 8.2, 8.3%, depending on your credit score.
Right.
But it's going to require 25% down payment.
Right. So, $300,000, you need $75,000 plus your closing costs. So this is what I want to add to the Airbnb. I've been in the Airbnb business before Airbnb was even a thing. And that was homeaway.com. And I was doing it down in Puerto Rico, and I was doing it in Miami. I had a few apartments in Miami, and I had a few apartments in Puerto Rico. I think we had 10, 12 units. And I was generating $40,000, $50,000 a month in revenues.
Okay.
And my net profits were like $10,000 to $15,000 a month after all expenses. But what happened with the Airbnb net profits were like $10,000, $15,000 a month. So what happened was so many people got into the business that my sales went from 50 to 40 to 30. And then the other thing,
because of competition.
Right. Everybody just got into it, right? Everybody that you spoke to.
What year was this?
I started in 2000.
Okay.
So that was 20 years ago, right? 22 years ago. So the other thing that happens is the Airbnb business is based on disposable income, right? So when you have extra money, you're like, I'm going to Orlando, I'm going to the Caribbean.
Which is what happened the last 2 years of COVID.
Right.
Tons of disposable income.
Right. People just went crazy. There was a lot of government money. But as you know, the markets go up and down.
Right.
So what happens is when the market tightens up, people don't go on vacation as much. So your rentals go down. So you have to be careful because you get this big push and everybody's talking about Airbnbs, and you also have to, everybody's like, Airbnb, you could make $10,000 a month, $6,000 a month on a 2-bedroom. So you have to be careful. And the other thing that I notice is, like in the Caribbean, every couple of years I get hit with a hurricane.
Yes.
So when I get hit with a hurricane, my recovery is like, say, a year. Because by the time we get the damage and we fix everything up, and then the media starts to say, oh, Orlando is doing well again, Florida is doing well again, Puerto Rico is doing well again, that changes the sales.
Absolutely.
So right now, when I think about going on vacation, I don't want to go to Puerto Rico, and I really don't want to go to Florida. So I'm like, all right, I want to go to Hawaii, I want to go to Dubai or whatever. So you have to be careful because you can't bank on that. So you as a professional, we want to provide a great product and help people, buy assets and make money. But we also have to say, hey, there are situations that have occurred in the past, that will occur in the past, that you need to be prepared for.
But that's why you need to study your market.
Right. So Vic, we covered some pretty cool stuff. We covered interest rates.
We did.
What else we covered?
Rise in interest rates, first-time home buyers, getting creative
buy downs
with the financing, buy downs, Airbnb investing, how builders and developers are switching strategies to really figure out how to help the end user purchase their product.
You got to use a loan officer like Vicky that sits down with you, explains everything to you. That's
is going
honest.
through the process herself. Has gone through the process herself.
And is going through it. But Vic, I really admire everything that you do. You work like 7 days a week. I follow you. I hear you, like, you're working on Fridays, Saturdays, Sundays. I'm like, she never takes off.
The market never takes off.
I know.
Why should
but you need to
for now,
chill out for a little bit. But she works. And if you want somebody that works and that knows what's going on in the market, knows, what's happening, like, she's like front line. So this is the woman. When I'm home relaxing, Vicky's at an open house on a Saturday and Sunday, which is crazy.
Appreciate that.
But I really admire you. You're young, you're successful. I can't wait to see your growth over the next 10, 15 years.
Thank you so much.
You're a role model for a lot of women, young women and a lot of women. So keep doing what you're doing. I can't wait to see what the future holds for you.
Same for us.
You rock, she rocks, and I admire you.
Yeah, I want to be like you. I want to flip 7 properties a year.
7 to 10.
Thank you.
But the cool part is that you're like a role model. You must be a role model to your daughter.
Yeah.
Because I know that you have how old is your daughter?
16.
16. So, she sees her mom like young, really doing it, being successful, and I think that's a good position to be in for your daughter. To be proud of you. I hope she's proud of you.
Thank you.
I hope she's proud of you.
Thank you.
Yeah.
Yeah.
Yeah. She respects her. She's crazy.
She's very independent. She's got a very independent mindset. Yeah.
All teenagers are the same ways.
Do.
But Vic, thank you for coming to visit us. And if you need any help with your construction, with your house.
Well, you're going to build me a house in 2023. So
2025, 2024. Maybe we'll just get a better house. We'll get an ugly house in a really nice neighborhood at a really good price, and then we'll build it.
Oh, it's exactly it.
We'll build a basic house though, nothing fancy.
Nothing fancy.
So we could keep the mortgage payments down.
It's beautiful. I love it. Thanks
Vic,
so much.
Thank you.
Thank you.